Hello friends, welcome to Enjoy Financials classes. Today I am going to discuss one of the very important topic, that is deferred tax liability and deferred tax assets. Because there are a lot of confusions in how the transaction takes place in the balance sheet, that is also equally important to know. That's why I am today going to discuss about what is deferred tax liability and assets. But before we dwell upon these topics, let me first discuss that how the current liability or provision for tax is created, how the companies are paying from the available amount in the balance sheet. Then we will come to the deferred tax liability and deferred tax assets. Suppose friends, there is a company and it has made total sales of suppose 1000. Okay, 1000 rupees that sales company has made, and they have purchased the raw material of suppose 600. Okay, then electricity consumption of suppose 200, labor consumption suppose 100. Okay, now other expenses total, all others means you cover, please treat all the expenses, suppose 10 rupees. Okay, so the total expenses is coming around 900. This total expenses is 910 rupees. So the profit before tax for the company is 90 rupees, right? So now tax, suppose I am calculating here at 30% tax. Okay, so 30% tax is coming around 927 rupees. So now if you see friends, the profit after tax for the company is 63 rupees. So if the people who knows a bit about the balance sheet, so he must be knowing that in the balance sheet of the company, that reserve and surplus, now this amount, this 63 rupees amount will be transferred to where? Reserve and surplus, right friend? So in the reserve and surplus 63 rupees will be transferred, and on the asset side this 63 rupees will be there. So now the asset and liability matches. But friend, you think of this 27 rupees also. This 27 rupees, see, the company has not paid yet this 27 rupees, because at the time of preparation of the balance sheet they have made the provision that 27 rupees the tax the company is supposed to pay. So as on 30, this balance sheet is as on 31st March suppose 2023. So at the time of preparation the amount was not paid. So what will happen? This company has received, means has arrived at 63 rupees of profit after making the provision of taxes of 27 also. So but since it has not paid, so this cash 27 rupees is also lying in excess by the company, and to tally this tax the excess cash is of whose monies now? So it is of now the income tax money, na, means income tax they are supposed to pay. So now the provision for tax on the left side they will show this 27 rupees. So what will happen? So at the time of preparation of next balance sheet or after 2-3 means what will do, the company will pay these 27 rupees to the income tax department. Okay, this 27 rupees they will pay after 1 month, 2 months or 3 months, but after preparation of this 31st March balance sheet. The moment they will pay, so now since I paid, so company need not make the provision also. So both side it will nullify, and the balance sheet, that 27 rupees will not be there in the balance sheet. So this is how the provision for the tax will takes place. Now we will discuss on that how the deferred tax liability and assets are created. Okay. Now friends, just you treat that there is a company, and who is having, the company is having plant and machinery of 1000 rupees. Okay, and the depreciation, see, the deferred tax liability and assets are created because of difference in the depreciation, because of difference in the depreciation as per company act and as per income tax act. Income tax act, please do remember friends, because of this only that deferred tax assets and deferred tax liabilities are created. So hope ki you people will not miss So now I am coming to the that how the deferred tax assets and liability are being created. Okay. So now just take the example that company is having one plant and machinery of 1000 rupees, and as per company act the depreciation to be provided in this company is 20%, and as per IT act the depreciation to be provided in that company is 25%. Okay. So now the company has suppose made the sales of 1000 rupees, and now the raw material consumption is 600. Okay. Now all other manufacturing expenses is suppose 100. So now the company having profit before tax and depreciation is 300. Okay. So now the depreciation on plant and machinery is 20% as per, this is as per company act, and this is depreciation as per income tax act. So now 300, now you see friends, the 20% depreciation means 200 rupees depreciation to be provided, right? So see what is depreciation, that we will discuss in detail in the later video, but here you see the depreciation that 20% they have provided. So now this 100 is what? Profit before tax. Now if we conclude that 30% is the tax, so now that company has to pay 30 rupees tax. So 70 rupees that that this is the 70 rupees is profit after tax. So these 30 rupees is the tax that company is supposed to pay, but only when the depreciation is at 20%. So what will happen in the balance sheet? What company will do? They will write on the left side reserve and surplus how much? This 70 rupees. Okay. And now this, so cash on the asset side, what will happen? Cash will increase by 70 rupees. But now you see, but provision for tax is how much? 30, and the cash is also 30. So what will happen if the depreciation as per income tax act and company act is same? So company will pay this 30 rupees to income tax, and provision for tax that will also get reduced from the liability side. This is the liability and this is the assets, and balance sheet dated is 31st March 23. Now you presume friends from the, as per the income tax act the company is preparing the balance sheet. Friends, please do remember that company has to prepare the balance sheet as per company act, whereas company has to file the return as per income tax act, and they have to provide the depreciation also as per income tax act. So same example I am taking, that the company has made in the same year, now they have prepared this, they have finalized the balance sheet, but now they are paying the tax as per company, so they are showing the transaction as per income tax act. Okay. So raw material is suppose 600, they will show. Other manufacturing expenses is 100. So now profit before tax and depreciation is how much, friend? 300. So now you see friends, as per IT Act, they are saying make the provision not 20%, make the provision 25%. So now the depreciation as per income tax act is 25%. So the profit before tax is coming how much? 50 rupees. So profit before tax is 50%, 50 rupees. Now add 30% tax. So it is coming how much? 15 rupees. So profit after tax is how much? Only 35 rupees. Okay. Now you see friends, as per company act, because of the difference in depreciation, company has already made the provision for tax 30 rupees, whereas as per income tax act it is supposed to pay only 15 rupees. So what will happen? Company will pay 15 rupees from here, and remaining 15 rupees it will show in cash or in other form of assets, and the from liability side 15 rupees will be reduced, and they will not show now provision for tax, they will show deferred tax liability as 15 rupees. Now friends, we will discuss why we are showing here as a deferred tax liability now, not provision for tax. because this 15 rupees now company need not pay immediately. Company has to pay maybe after 3 years, 4 years, 5 years or 10 years depending upon the depreciation that has been booked as per the company act or as per the income tax act. So, friends, every year the company will now, as per Company Act, they will debit the 30 rupees, whereas it, as per Income Tax Act, it will pay the 15 rupees. So, every year the deferred tax liability will be created by 15 by 15 by 15. Total 60 rupees of DTL will be created. Why? Because every year the company will pay less rupees. How much? Minus 15, minus 15, minus 15, minus 15. Now see the situation on fifth year. Fifth year also that the company as per this now you just assume the situation of fifth year. So fifth year also the company will debit as per income as per company act 30 rupees tax. Why? Because on the fifth year also the depreciation as per company act will be 20%. But as per income tax act, now as per IT act, now the fifth year the situation will be different. Why different? Because as per income tax act, again the company will show 100 rupees sales, raw material same 600, other expenses 100. So now the profit before tax and depreciation is how much showing? 300. Okay. Now the depreciation as per income tax will be zero. Why the depreciation as per income tax will be zero? Because already 25%, 25%, 25%. So all 4 years the company has provided the depreciation as per income tax. So the profit after depreciation but profit before tax will be also 300. Now the tax on 30% rate will be not now 30 rupees. Now the tax will be how much? 90 rupees. Whereas so profit after tax of the company will be how much? 210 rupees. So now you see friends, now the company has to pay as per income tax act how much? 90 rupees. Whereas company as per company act still the company has made the provision of 30 rupees. So now this provision for provision for tax the company will make here 30 and the cash will again increase 30 rupees for the current year means fifth year. But the you see friend that 60 rupees is this, that 60 rupees that has been accumulated over the period of 4 years, this 60 rupees deferred tax liability that has been this amount, this has been accumulated over the period of 4 years. So now you see the 30 rupees of current year and 60 rupees of deferred tax liability, total 90 rupees. Here also 60 rupees cash which is lying every year excess and 30 rupees cash for the current year. So total 90 rupees that company will pay from this side. So both side this 90 rupees as per income tax rate company will pay 90 and both side the deferred tax liability and provision for tax will be removed from liability side and 90 rupees payment will be made. Now friends, let us understand with an example. It will give more clarity. I have prepared the same for easy understanding in the Excel format. Here you see the total value of the plant is machinery is 1 lakh and every year the company is making the depreciation as per company act 20% and as per IT act the 25%. So every year the 25% as per income tax act, in 4 years the depreciation will become zero means the depreciation 100% will be provided and as per company act 20% means in the 5 years the value of the plant and machinery will be provided. So now you see 5 lakh rupees is sale. Why I have kept everything uniform for the better understanding. If I either increase or decrease the sales, the taxes will increase or decrease. So that's why the you may not be able to understand in the proper way. That's why I have made everything uniform, that all the 5 years the company has made the 5 lakh rupees sales. All the 5 years the company has incurred the expenses on raw material, manufacturing expenses, other expenses same. Okay. Profit before depreciation and tax is how much? 1 lakh rupees. okay, every year. So as per income tax also the same. Now coming to the role of the depreciation, as per company act 20%, 20%, 5 years it has provided. As per income tax 25,000, 25,000, 25,000 company has provided. So now you see profit before tax as per company act is 80,000, whereas as per profit before tax as per company act is 75,000. So on 80, since the profit before tax is more, so tax will be more. Whereas as per input tax, 5,000 rupees profit is less, so tax will be less. So now you see, friends, they are debiting the tax of 24,000 every year, whereas to income tax department they are paying 22,500 only. So every year 1,500 that surplus is being created by the company. So that 1,500 the cash excess lying with the company. Okay, and on the liability side that it will appear in the form of deferred tax liability 1,500 rupees. Okay, why in the form of 1,500 deferred tax liability? Because why it will appear in the form of deferred tax liability, as I said already, that since the amount is not payable immediately within a period of 1 year, so now the company will have 6,000 rupees of surplus. Means they have debited 24,000 but paid 22,500. So 1,500, 1,500, 6,000 surplus is lying with the company over the period of 4 years. So on the last year, if you see, as per company act, still the company has debited 24,000. But as per income tax act, there is no depreciation, and because of this, the tax is now increase to 30,000 rupees, from 22,500 to 30,000. Whereas as per company 24,000, that is uniform. So now you see in the current year the company has debited 24,000, whereas it has to pay the 30,000. So there is a difference of exactly 6,000 rupees. So how the 6,000 rupees will be made? Of course, it will be made from the deferred tax liability and the excess amount which is lying with the company. So if you see, friends, that the one total tax overall will remain same, be it as per the company act 1,20,000 or be it as per the income tax act. In the both the cases, the taxes are same 1,20,000. The only thing is that it is in the time difference of the provision for tax. That's all. And because of that only the deferred tax liability has been created. Now, friends, what is deferred tax assets? The deferred tax is just the opposite role of deferred tax liability. So, as per Income Tax Act, you see, as and the depreciation is 20%, and as per company, depreciation is 25%. Okay, so because of that, you see, friends, because of that, if you see, friend, that 22,000, 22,000, 22,000, 22,000, 22,000. So total in the 4 year, the total company has debited 24,000, whereas company has paid how much? 24,000. So 1,500 company has paid. So now, friends, I will tell you with the live example. Okay, take the same example. Okay, friends. Again, same, friends, the company is having total value of plant and machinery how much? 1 lakh. Okay. Now the company is having, now as per company act how much the depreciation is having? As per company act, company is having depreciation of 25%. And as per income tax act, the company is having depreciation of how much? 20%. In the value of plant and machinery is 1 lakh. So now the sales is suppose 1,000 rupees as per company act. Now I am preparing the balance as per company act. Okay, and this is the first year. So now sales is 1,000. Same raw material expenses 600. Other expenses 100. So total now profit before tax and depreciation is how much? 300. So now as per Income Tax Act, the depreciation will be how much? 250. So now profit before tax is equal to how much? 50. Now the tax at 30% will be how much? 15 rupees. So profit after tax will be how much? 35 rupees. So this will be the profit after tax. Okay, now you see, remember friends here that in the reserve and surplus, it will reflect on the 35 rupees on the liability side, and on the asset side the cash level will increase by 35 rupees because the profit has been transferred to the balance sheet, and this is the position of 31 March 2023. Now you see friends, as per the same cheese, as per income tax act, okay, income tax act, how much? Same, sales 1000, raw material 600, other expenses 100. So now the total profit before tax and depreciation will be 300. But depreciation as per company act will be how much? 200. So profit before tax will be how much friends? 100. So now the tax at 30% will be how much? 30. Okay. So now profit after tax will be how much? 70. Okay. So now you see friends here, the as per company act, the company has made the provision of how much? 20. So here they will write provision for tax how much? 15. Whereas so the cash is also lying excess with the company 15. But as per income tax act, they have paid how much? This 30 rupees they have paid. Matlab 15 rupees excess they have paid. So from where they will pay? They will pay from their own excess cash, na? So see, provision for tax will become zero. Why zero? Because company has paid 15 rupees from here. That provision made already. Now the remaining 15 rupees company will pay from the cash. So here the cash will be 20, and here it will show deferred tax asset as 15. Okay, why? Because it has paid 15 rupees excess from the cash, whereas provision was made only 15 rupees. So now every year the company will make 15 plus 15 plus 15 plus 15. Total how much? Deferred tax assets the company will pay 60 rupees. And every year the company will cash they will pay from where? Instead they have transferred the cash 35 matlab from reserve and surplus, but every year the cash will be reduced and become 20 plus 20 plus 20 plus 20. So now you see again in the last year see friends, as per income tax act the tax will be, as per income tax act the, just a minute friend, let me minimize. As per income tax act that depreciation will be same 200. Why? Because every year the up to fifth year same. But as per company act, now you see, as per company act sales it will again remain. Now I am discussing the fifth year. So 1000, raw material 600, other expenses 100. So total profit before tax will remain 300 same. But the last year the depreciation will be how much? Zero. So now the 300 will be the total profit as per company act, and now the total company is how much they are supposed to pay? 90 rupees. That is the tax at 30%. So profit before tax will be, profit after tax will be how much? 220. So now the company has to make 90 rupees tax, whereas as per income tax act they are saying still you pay me 30 rupees only. So here how, what will happen? Provision for tax, how much will be there? Provision for tax will be 90, and the cash level will also be increased. Now the cash level will be here how much? Cash I write here at the top, the cash is equal to 90. So what will happen friends? You see the deferred tax asset is 60. So what will happen? So deferred tax assets will become zero because it will say, it will say to the income tax already I have paid 60 means this year only they have to pay only 30 rupees. So deferred tax asset will become zero. Okay, and the cash, from cash they will pay to income tax department 30 rupees, and the deficit which they have paid now this 60 rupees every year the excess, so now it will come back to cash. So 60 rupees means 15 15 15 which they have paid. Now again the asset has been created from the where? From the excess cash, and now the provision for tax will also become zero. Now you see friends, so how the deferred tax asset is also created, and for that I have prepared one Excel format for better understanding. You see in the same way Here also that deferred tax because of see as per Company Act 25%, 25%, 25%, 25%. So 100% depreciation in the 4 months, 4 years it was made, and the tax is also 20. But in 20,500, 20,500, 22,500, 22,500. So every year the company has, as per Company Act, they have made the less depreciation, less, sorry, they have 1,500 every year, they are making the less provision, whereas they are paying the 24,000. 1,500 from there, where they are paying from the cash, okay, the 1,500. But in the last year the Company Act, they have debited how much, the provision for tax is 30,000, whereas still to income tax they have paid 24,000. 6,000 that excess payment they have made now from the cash, now they have recovered for, as per the Company Act, this 6,000 rupees. So this is what the I wanted to make you clear about the deferred tax assets and deferred tax liability, this concept, friends. I will tell you this Excel sheet I have prepared for the understanding purpose, for the knowledge purpose. Nowhere you will get such type of things for understanding. It is my own idea, so that understanding yourself means is a different thing, but teaching someone in the way so that they should be able to understand is completely different. So hopefully that this video will like you very much. Thank you all. Have a good day.